Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Understanding Capital Structure, Key Insights for Businesses and Investors. Industry characteristics. Different industries have distinct capital structure norms. Certain sectors naturally lean towards higher debt levels, while others prioritize equity. Understanding these trends is essential for companies in specific markets. Capital-intensive industries. Sectors like manufacturing and utilities often rely on debt. They need large investments upfront, but enjoy stable cash flows over time. Technology firms. These companies may prioritize equity financing, especially in early stages, to fund research and growth without the burden of debt repayments. Industry characteristics also dictate risk profiles. For instance, regulatory environment. Heavily regulated industries might face restrictions on debt levels. Market demand volatility. Industries with unpredictable demand may prefer equity to avoid debt risks during downturns. Growth potential. Fast-growing sectors may attract investors willing to provide equity funding. Recognizing these industry-specific behaviors helps companies align their capital structure with market expectations and norms. Optimal capital structure. Finding the optimal capital structure is key for any business. This concept revolves around balancing debt and equity to minimize financing costs while maximizing long-term value. But how do companies figure out what is optimal? The trade-off theory. The trade-off theory helps explain how companies balance the costs and benefits of using debt. It suggests that businesses seek an optimal point where the marginal tax benefit of debt equals the marginal cost of financial distress. Benefits of debt. Debt can lead to tax savings since interest payments are often tax-deductible. This reduces the overall cost of capital. Additionally, using debt can amplify returns when a company does well. Costs of debt. However, excessive debt can lead to financial distress. High debt levels increase the risk of default, which can harm the company's credit rating and lead to higher interest rates on future borrowing. The balance comes down to assessing these trade-offs. A business might use debt to fuel growth, but must ensure it can handle repayment obligations. This balancing act is where the trade-off theory shines, helping organizations decide how much debt to take on without sacrificing financial stability. The pecking order theory. The pecking order theory focuses on how companies prioritize their financing choices. According to this concept, businesses prefer to fund projects using internal resources first, then debt, and only as a last resort, external equity. Internal funding. Companies often reinvest profits before considering other financing sources. This avoids additional costs associated with borrowing or issuing new shares. Debt financing. If internal funds aren't sufficient, companies will typically opt for debt. Borrowing is usually cheaper and less dilutive than issuing equity. Equity financing. Finally, if a business cannot finance through the first two options, it will look to equity. However, issuing new shares can dilute ownership and is often viewed as a signal that the company may be overvalued. Understanding the pecking order theory is essential for evaluating how companies approach financing. It sheds light on why some businesses may seem cautious with debt, while others aggressively pursue growth through borrowing. Impact of capital structure on financial performance. The way a company chooses to balance debt and equity significantly influences its financial performance. Both return on equity and the overall cost of capital hinge on the structure of a business's financing. Understanding these relationships can help both managers and investors make strategic decisions for better profitability and risk management. Return on equity, ROE. Return on equity, ROE, measures how well a company generates profit from its shareholder equity. A company's capital structure plays a crucial role in this calculation. Using debt financing can enhance ROE. When a company borrows money at a lower interest rate than its return on investments, it can increase its profits relative to equity. This leads to a higher ROE, making the business appear more attractive to investors. However, there's a trade-off. If the company's returns are lower than the cost of debt, ROE can plummet, signaling poor performance. Investor perception is closely linked to ROE. Higher ROE can attract more investors as it suggests effective management and the company's ability to generate profit. However, high ROE driven by excessive debt can raise red flags. Investors may worry that the company is taking on too much risk, which can lead to volatility. It's essential for companies to demonstrate not only strong ROE figures, but also a balanced approach to maintaining risk. Cost of capital. The cost of capital represents the expected return necessary to persuade an investor to put money into a business. This metric is directly influenced by capital structure, which consists of both equity and debt. When a company relies heavily on debt, it might initially lower its overall cost of capital. Debt financing is often cheaper than equity because it comes with tax benefits. Interest payments can be deducted, lowering taxable income. However, as a company takes on more debt, the risk of financial distress increases. Higher risk may lead lenders to charge higher interest rates, raising the cost of capital. On the other hand, a higher proportion of equity increases financial stability, which can lower the cost of capital over time. Investors might demand a lower return on equity if they perceive the company as less risky. Finding the optimal mix of equity and debt is crucial. A well-balanced capital structure can lead to a lower overall cost of capital, enhancing a company's value and profitability while managing risk effectively. In summary, understanding how capital structure affects ROE and cost of capital helps businesses and investors navigate financial performance. Balancing these elements can lead to better profitability and lower risk. Case studies of capital structure in practice. Examining real-world examples of capital structure can provide valuable insights into how companies manage their financial strategies. Understanding successful decisions and mistakes made along the way helps shed light on best practices and potential pitfalls. Successful capital structure decisions. Several companies have effectively managed their capital structures, leading to growth and stability. Here are a few noteworthy examples. Apple Inc. Apple has a strong balance sheet with a mix of debt and equity. The company uses debt to fund share buybacks and dividends, taking advantage of low interest rates. This approach allows them to retain cash for innovation while providing returns to shareholders. Tesla. Initially relying heavily on equity financing, Tesla has shifted towards a more balanced capital structure. Its increasing revenue and market position have allowed it to take on debt for expansion while minimizing dilution for existing shareholders. This strategy has enabled Tesla to invest in new projects while maintaining adequate liquidity. Microsoft. Microsoft manages a conservative capital structure with a healthy mix of debt and equity. Their strong cash flows allow them to service debt comfortably. This enables the company to innovate and invest in growth while maintaining financial stability. These companies demonstrate that a thoughtful approach to capital structure can support growth and enhance shareholder value. Mistakes in capital structure choices. Not all companies get it right. Poor capital structure decisions can lead to financial troubles. Here are some cases worth examining. General Motors, GM. Before filing for bankruptcy in 2009, GM had a significant debt load. High levels of borrowing restricted their ability to invest in new technologies and made them vulnerable during economic downturns. A lack of flexibility in their capital structure contributed to their financial downfall. Toys R Us. The toy retailer faced challenges due to its capital structure, with heavy debt from a leveraged buyout in 2005. This debt burden limited their ability to invest in e-commerce and adapt to changing market conditions. Eventually, the inability to manage debt effectively led to their bankruptcy in 2017. Kmart. Similar to Toys R Us, Kmart suffered from an unsustainable capital structure after a leveraged buyout. High debt levels constrained their operational flexibility. As competition intensified, Kmart struggled to maintain sales and eventually filed for bankruptcy. These examples highlight the importance of a balanced capital structure. Poor decisions can limit future opportunities and increase financial stress, leading to dire consequences. Understanding these cases can help businesses make more informed choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.